Hello there, everybody. Welcome to session 1 of the Max Scalping course for this July 2022, and then just a wee little bit of August next Monday. This is Craig. I'm here with Eusebio and Chris and Gregory, and it's very nice to see you in the room today. And others will be experiencing this session by video, so we welcome all of you to the Scalping course. By the way, if you're listening and haven't logged into the chat room, go ahead and do that if you would, please. Just a reminder that we do not ordinarily use the GoToWebinar chat or question area during the class webinars. So get into the Chatzy room, and if you're, well, you can't hear me if you're in the Chatzy room, but we're still waiting for a few to get into GoToWebinar. So we apologize for that brief delay. And just another reminder, it takes me about 24 hours to add the copyright security ID to the videos and then to get your copy uploaded for you, which will have a unique identification that's tied to your name. So please be careful not to share it with other traders. And I know most of you that's unnecessary, but once in a while we have a problem with that. I'm very excited for you. Some of you improving your skills with this course, some discovering a brand new trading method. And yes, it's some work, but the goals are more than worth the effort. Eusebio is our lead instructor for this course. He's assisted by Gregory, and Chris is here as well. And so most of you already know how fortunate you are. And I hope you will take advantage and give your very best efforts to this course. I think we're ready to go, so let's do it. And our thanks to you again, Eusebio, for your efforts on our behalf with this course, and it's a pleasure to give this class to you. The microphone is yours.
Thank you very much, Craig. And in fact, it's always a pleasure for me to teach something, whatever the subject, especially trading subjects. So welcome, everyone. I'm really glad to see you today in this room, and I also welcome the students who will follow the course through the video as Craig has explained. And before starting, you know that I always like to make a quick audio and video check. Do you see my screen and do you hear me well? So if you would like to type a yes or a Y in the chat, I would really appreciate. Well, thanks Gregory, thanks Mark, thanks Chris. So really I appreciate. Okay, so let's start today with this called the Max Scalping system. Next time we will give this course, I will drop the ETF portion of the name because we no longer use the ETF in all our Max courses. We have used the term ETF when we have introduced the ETF lines and companion indicators, but now that everyone are well accustomed to these indicators, so it's no longer necessary to introduce that acronym in the name of the Max courses. So I will update the PDF for the next time. So what is the content of this course, and especially the session 1? So I will explain what is the aim of this course, of course. And I will explain the organization of the course. And then today what I'm going to do is I will explain each indicator and script or tools we will use in this scalping system. And so I will explain each indicator individually. This will not be enough, of course, to know how to scalp with these tools, but it is an important basis to understand later how we can combine them together in order to have the scalping system. And then I will show you how to activate the indicators and the script on your chart. And so what is the aim of this course? In fact, the aim of this course is to provide a very safe, very reliable scalping system. When we use the term scalping, most of the time we mean a way to catch some profits through one or several trades, staying as less as possible in the trade. So this means exiting or closing the trade as fast as possible. This is usually what is called as scalping, and this Max Scalping system will obey also this rule. But with this scalping system, of course, I will explain the concept and the rules we will use. And as you will see, these concepts and rules will be based on a very, very important concept of the market mechanism. You know that the market, especially the forex market, does not move randomly, and this is true for any financial market. And if you understand some concept for the reason why a market is moving, then you gain one or several edges in your trading. And when you get even just one edge over the other traders, so you will become profitable. The aim, of course, of this scalping system is to be also as mechanical as possible. I will never claim that it is a 100% mechanical system. It may be sometimes to have the necessity for a small discretionary decision, but it will be just a very, very small portion of the entire system, and I will explain that much more in details in the session number 2, when we will see some nuances. But it is completed with a very strict, extremely strict trade risk management. Because if we want to be out of the trade as soon as possible with a profit, this means that we need, first of all, to have a complete control of the risk we are taking on the trade, and we need to be fast in the way to take a decision and to apply the decision. And because we want to go fast in the trade, and we want to have a reliable and safe trading system, this scalping system will apply only to the very liquid pairs in the forex market. And when I say very liquid pairs, I mean essentially the majors. And so we have, you know that we have 7 major pairs, so all the pairs with the US dollar, because they are indeed the most liquid pairs. And we can still include, and if I'm wrong, Gregory will correct me because he is the specialist of this trading system. I think that with the present context, especially with UK and the European Union, we can still include the euro-pound in this list of pairs we want to scalp. So, so this is for the aim of this course. Where is my cursor? Oh, yeah, here. So how do we organize this course? As you know, we have 2 sessions. So, and along these 2 sessions, I will introduce progressively all the concepts and the rules. For the session 1, as I have explained just previously, will be essentially dedicated to the specific indicators and script, and I will describe how to use them individually. And then in the session number 2, I will explain how to combine them together in order to have our trade setups. But before defining the trade setups, I will have to describe different levels of trades, because when we consider a scalp trade, we can also associate the level of safety or the level of risk to that trade. And as you will see in the session number 2, we will have several levels of risk or type of trade, type of setups. And so when you will see that it is very, very easy to define the level of the trade, and then we will have the trade setup itself. And then I will add some nuances, because as you know, whenever we have a concept or a rule, if a concept or a rule may be general as possible, sometimes it's necessary to introduce some nuances. Now, just to give you a small idea of what kind of trade you may have before introducing the tools, the indicators, and script we will use based on some very important market mechanism, let me show you some example of past trades, just to give you a small idea what these trades will be. The first one is here on the Kiwi US dollar pair. And the Kiwi US dollar is indeed a major pair because it contains the US dollar. It is on the 5-minute time frame. And you can see that the price was moving down, up, down, up. It was not moving in big ranges, but at some point we had on this candle, this red candle here, a nice entry setup. At the close of the candle, a nice entry setup, and then an entry. And then later on, and this will be described in the nuances, we will have a second entry. And when you have these green notation, this means the entry, and then the white mark represent the exit, catching the desired profit we wanted on this trade. And so a very fast trade. It took 5, 10, 15, 20 minutes to see the price moving in the direction we were expecting, and then to catch the profit, the intended profit. So this is an example with 2 entry in this scalp trade. So most of the trade will contain only 1 entry. This is another example with the US dollar CAD. At some point, so the price was moving upward, but we were expecting a short trade, and you will understand in the session number 2 through the set of conditions we will establish for this trade. And at some point with this green candle, we had an entry setup with the entry with this red notation, and it took 2 or 3 bars, so less than 15 minutes, to catch the required profit and still have a winning trade. And so you see a trade is very fast. On the 5-minute time frame, 2 or 3 bars is really fast to catch the intended movement or minimum profit. Another example was on the US dollar Swiss. We were also looking for a short trade. And again, we have this green candle, which has been defined through the set of the conditions we had as our setup bar. Then we had our short entry, and less than 10 minutes later, the intended profit was achieved and the trade closed. And I could illustrate many of such trades. This is another one with the US dollar Swiss. Again, it is a different one. So we were looking for a short trade, and at some point we had the entry. Note that, because some of them may ask the question, this red down arrow is not the entry setup, of course. It will correspond to one of the conditions we will look for in order to have a trade. So we have the entry, and it took this time 1, 2, 3, 4, 5, 6 candles for the profit to be obtained. And so all these trades are scalp trade, and sometimes a scalp trade, if the price continues to move in the direction defined by the trade, sometimes we can transform a scalp trade into a trend trade or into a swing trade. And so if you master at the same time the scalping system and the max standard, especially the max standard, sometimes such a scalp trade can be transformed into a trend trade. But we will see that in the session number 2. Have I another one? Yeah, the US dollar Swiss. This is an example when the US dollar Swiss, a moment when it was very, very active. So we were looking only for short trades. Again, 1 entry. I think it was, I have shown it previously. So yeah, it was the previous chart. And later on, a few bars later, we had a second entry setup, which has required later to have a second and a third entry, and finally the trade has been closed with a profit. So a 3-entry trade with a final exit, taking the profit we were expecting to take. So sometimes a max trade can require to have several entries using an idea based on the concept of averaging down. It is not exactly averaging down, but it looks like averaging down. And sometimes it will be extremely useful. And the last example I will show is the US dollar yen, another pair. So the US dollar yen is also a pair which can be sometimes very volatile. And here we have again a sequence of a scalp trade with 1, 2, 3 short entry, and then the price has moved in our direction, and then an easy profit has been caught within a few candles. And so this is the kind of trade you can expect to have as a scalp trade. And so in order to know what are the entry setup, so you will need to wait for the session number 2, because of course we will use special tools you don't know yet, at least for the moment. You recognize some tools. For example, we have the slow buyers and the fast buyers you recognize. We will use them a little differently than in the max primer or in the max standard. Basically, it will be the same usage, but we have other tools for which it is necessary to explain how to use them. So let's move now to the beginning of this course. So in such a way that you have an idea of what you may obtain so after the session number 2. So we will use a certain number of indicators, in fact 1, 2, 3, 4, 5 indicators and one special script. So among the indicators we will use, as you have seen and recognized on the example I have shown previously, we have the slow bias and we have the fast bias. The fast bias is not an obligation, it's an option. If the fast bias will be in agreement, that's fine, but it's not an obligation. For those of you who are used to already exploit the two companion indicators, so you can continue to use both of them. But the main indicator will be the slow bias. And then we will have an indicator called the no-no market profiler, then the no-no cumulative delta, and the no-no quantic indicator. And for a script, we will use a specific script, which is called the No-retail-recon. And so you see a very small number of tools, but this will be enough, well enough, when you will know how to use them and especially how to combine them together. And so let's describe, one by one, the description of these tools. And I will begin with the No-retail-recon, which is a script. And I will illustrate in a moment how to use that retail recon. But what is the idea behind the retail recon script? In fact, as you can see here on the PDF, it allows to measure the level of sales and buys in the retail space. And there is a special reason why we consider these levels of sales and buys in the retail space, because you know that most of the time, or enough, the retail traders are wrong. Of course, even if there are now around 25% of profitable retail trading accounts, there is still a vast majority of retail traders who are losing in the market. And if they are losing, this means that they are wrong. And the big boys exploit the fact that the retail traders are wrong to extract additional profit. And so this is what we want to do, in which direction the retail traders are. And this script will give us also a very clear idea of the current context within a currency pair, because each currency pair may have its own context. The context for the US dollar CAD will not necessarily be the same as the context of the US dollar yen, for example. It depends of the relationship between all these individual currencies. And you know that analyzing the global context is not an easy task. It represents an important amount of information to analyze, to compile, and to analyze. But this retail recon script will give us a very quick idea of what is the current context for a specific pair we want to scalp. And in fact, it will validate or invalidate, we can say, the power of a setup. As you will see next week, we will have several levels of setup, several types of setups, depending on the risk they will represent. And so in some circumstances, this retail recon script will tell us, okay, no, we don't have to trade that pair, or it may be a very safe trade, or it may be a riskier trade. And in many cases, in a vast majority of cases even, it will show in which direction the big boys are manipulating the market, knowing what the retail traders are doing. And this will be a very, very important information. Of course, nothing is 100% perfect, but when we will combine the context, the specific context given by this script with the other conditions to define an entry setup, you will see that the reliability of the setup will be extremely high. And depending on the level of risk of the setup, the reliability will be between 90% and almost 100%. This is why I say all these setups globally will have an average winning rate of around 95, 96%. But in some cases, it will be almost 100%. So what is this script now, this tool? I will show after that how to add that script to the chart. But let me explain how we use that information. So the script will be presented or will present such kind of information on your chart. And I will illustrate that so just in a very short moment. And it will show what is the percentage of retail trade which are short, and what is the percentage of trade which will be long. But not only the percentages of short or long trade, but also the volumes in lots, in standard lots. How many lots are short and how many lots are long. And so if we consider that most of the time the retail traders are wrong, if we have a vast majority of retail traders who are short and a very small minority who are long, what is the direction we should privilege? In this kind of results, you can see that a vast majority of retail traders are short and a small minority are long. And so what is the direction we should privilege in this case? The short trades or the long trades? Mark says the long trades. Is there another opinion? Don't be shy to give an opinion, because at worst you will be wrong, and if you are wrong, you will learn something positive, in fact. So don't be shy to give an answer or to give an opinion. No? You do not want? Okay. So, in fact, because the vast majority of retail traders are long, we are short, sorry, in this case are short, 94%, we can conclude that these short traders will be wrong, in fact. And what is the rule? In order for a situation like this one, in order to have a wrong side of the direction, so short here, we need to have a percentage above 70% and a total volumes larger than 5,000 lots. Because 5,000 lots in the retail space, it's a big volume. Let me check something. Ralph, you are writing, or you have made an attempt to write in the question area of GoToWebinar. Use the chat C if you want to type something, okay? Because we do not record the chat area or the question area of GoToWebinar. So use the chat C instead, okay? In such a way you will have a copy of the chat C in a few days with the recorded video. So I was telling that 5,000 lot is a significant volume in the retail space. And you have to consider that the retail traders represent an important volume in the Forex market. Important enough to get the attention of the big boys. And when the big boys see that many retail traders are essentially in one direction, they try to trap these traders in the opposite direction. And this is why, in fact, when we will have more than 70% of the retail traders on one direction with more than 5,000 lots, in this case short, we know that we will have to privilege the opposite direction because the vast majority will be wrong. And so in this case, the retail-recon information will define a bullish context for that specific pair. And we will have such result for each specific pair, as I will show in a moment. It is clear what is the logic behind that concept of the retail traders. Is this clear? Knowing that the vast majority is always or often, very often wrong. But in order to have a majority which is significant enough, we need to have a very large percentage, so more than 70%, and at least 5,000 standard lots. Oh, thanks, Gregory. I appreciate your comment. So on the next page, I will see the opposite example. So in this case, the vast majority are long. So 85% are long, with many more lots, 70,000 lots, so way more than 5,000 lots. And so in this case, obviously, there will be an attempt by the big boys to trap these long retail traders. And so we will have to privilege the short side of the market for this specific pair. And you can see that in the previous page, if I come back to the previous page, so when the conditions were fulfilled for the long side to privilege, so the indication is given in green. And when we have to privilege the short size, so the short line is indicated in red. No mark, it is not in tick volume because the information is not taken from MetaTrader. I will explain in a moment where the script takes these informations, okay? Well, and so when the conditions will be fulfilled, so when the percentage will increase above 70%, and there will be more than 5,000 lots on one side, so the correct side to privilege will be displayed in red if we have to privilege a short direction, green if we have to privilege long direction, and you will have a sound alert also on your screen. So there is a third situation we will have to consider. What happens when we still have a majority of traders, retail traders in one direction, but less than 70%. And in fact, our observations on many years have shown that if there is still a percentage between 60 and 70%, 60 and 70%, this is still significant, but this will define a neutral context. So we will have for this pair a neutral context, and in some circumstances, we can still trade that pair, and we will see how to trade that pair, so in the session number 2. Now, if the percentage is less than 60%, so between 50 and 60%, or if the conditions are not fulfilled to have either a strong context, a bearish or a bullish context, or a neutral context, so the retail-recon will not confirm, will give a not confirmed context. This means that in some circumstances, there will be no trade at all, okay? So now let me show you how to display these informations on your screen. And for that, I will switch to my MetaTrader platform. I have opened a naked chart to just hide what is behind on my screen. Let me close now this chart. And let me open, for example, here the US dollar-yen pair. And you see that on the US dollar-yen pair, we have this small box which is displayed, and it indicates that for the moment we have, for the US dollar-yen, we have to privilege, in fact, the long trades and not the short trade, because we have a vast majority of retail traders who are short on this US dollar-yen pair with enough volume, so more than 5,000 lots on the short side. So, because what does it mean for the big boss when there are a lot of lots in one specific direction? This means a lot of liquidities, and the big boys are always looking for enough liquidities. And if the retail trader can provide them some liquidities, they will take benefit of these liquidities. And more than 5,000 lots represent enough liquidities to interest, in fact, the big boys. Now, how is this script working? Let me show you that on a naked chart. Let me open, for example, I will take the US dollar yen again. Chart window, it will be a naked chart for the moment. We have a script which is called No-retail-recon. Okay, and so in the zip file I will send you today at the end of the session, this session. So this script will have to be placed in the script folder of your MetaTrader platform. Let me show you that quickly. So File, Open Data Folder. You will get the environment of your MetaTrader platform, and in the MQL4 file, you have the script folder, and you have to copy the script No-retail-recon in this script folder. You see, you have it here, No-retail-recon. So how does it work? You have simply to drag and drop the script on the chart. You will have that panel. You have to choose if you want to activate the alerts or not. By default, it is true, so the alert will be activated. There is no other parameter. Of course, in the command panel, you will have to check that the 4 usual boxes are checked. And then, so you click on OK, and you wait just a small moment, and the script will appear on the chart. And if the conditions are enough to generate an alert, in this case long or short, you will have the alert on the Windows alert. So a Windows alert will pop up and a sound alert will be generated too, in such a way that when you will be in real time, because you will have to follow all this information in real time, when the condition will change and when it will become interesting, you will be informed. And so in this case, for the US dollar yen, if a long entry setup at some point will appear, this will be a nice long scalp trade to consider. Now, where do we get through that script the information? You all know the website MyFXBook. So let me try to take it. I have not prepared the website. So MyFXBook. I need to connect, so just a moment. MyFXBook. Okay, so when we are in the MyFXBook website, there is a lot of information, so the MyFXBooks can give you. MyFXBook is a website which is used most of the time to have some news with a calendar, but to follow also some traders. And there is a community panel. And in the community panel, you have here a choice in this menu, which is called sentiment. And so if you click on this sentiment panel, you will have all, continue on my, okay. So you will land on this page, and this page will give you information about a lot of pairs. And so you have many pairs, which is followed by this website. If I take the first pair, for example, which happens to be the euro-US dollar, and you see that there is a bar which is partly red and partly green. And so the popularity also of the pair. What we are interested in is this red-green portion. And if we put the cursor on the pair name, you see that 43% are short, 57% are long, and for the volume, so there are in the short, for the short trade, there is a total of more than 5,000 lots, and on the long side, more than 7,500 lots. And so this is this information that the script takes from the website. If you change the pair, you will have also all this information. So euro US dollar, remember 43 and 57 pairs. And so if we go back on the MetaTrader platform and I take the euro US dollar pair, so euro US dollar, you see 43 and 57 plus the same volume. And so these information are taken in real time from my FX book. And my FX book, in fact, make the aggregation or a recap, if you want, of all the trades made by all the broker, all the traders with brokers which are connected to my FX books. And so this represents a vast majority, if not all the retail traders in the retail space, in fact. And so when we have such a volume of informations among almost all the retail traders, among almost all the brokers, then the tick volume is very representative of the real volume. There is a clear correlation, more than 90% correlation between the tick volume and the real volume we don't know. Okay? And this is why these information are reliable. But of course, the information are more reliable, way more reliable for the major pairs than for the cross pair. If you take a pair like the pound-yen, even if the pound-yen is one of the most volatile pair, you can see that the volume are small. On the short side, we have 951 lots. And on the long side, we have 612 lots. And so these are not the type of volumes which will get the attention of the big boys. To get the attention of the big boys, so we need to have several thousand of lots, okay, because they will represent the kind of liquidity they will need to manipulate the market in their favor, okay? Is this clear where we take the information through that script? Clear enough? Okay, fine. Of course, you can have the information directly on my FX book. And my FX book also provides an indicator you can download on your MetaTrader platform, but it is not a free indicator. It is an indicator with a monthly fee. And I consider that this fee personally is too high. But we provide the script for free in this course. And so you will have the script for free in the zip file I will send you later in this course. So this is for the retail, no-retail-recon. Is it okay for the explanation how to use it? So if there is a red color in the data, we will have to favor short trades. If there is a green line, we will have to favor the long trade. And if there is no color, we will have to check if on one side we have between 60 and 70% percentage of traders, of trades, and in which case we will have to consider the opposite direction. So when we have a red or green color, we will have a clear bullish or bearish context, a clear context. And when we will have a neutral situation, we will have a neutral situation. And in all the other possibility, we will have a not confirmed situation. And these will be the three conditions we will have to consider among the other conditions in order to have an entry setup. So this is for the script with the no-retail-recon script. Let's come back now to the PDF and explain the second tool we will use. Now we will use indicators.
Sorry.
Yes, Chris, please.
Yeah, sorry. If you can go back to the no.
Yeah.
So, please. Thanks. Yeah, I'm just a bit confused. You said if it displays red, you're going for short trades. If it displays green, you're going for long trades.
Yeah.
If it's, but then you said.
Let me re-explain. So if we have a red line, the red line will also correspond to the short side. So we will have to consider short trade because this will be a situation with a bearish context, a clear bearish context.
Yep.
We have to take the opposite side of the long, which is the majority. If we have the long in green, this means that we have a bullish context. So we have a clear context, either bullish or bearish. When we don't have a bearish or bullish context, we may still have a neutral context when the majority, which is the wrong side, will be between 60 and 70%.
Okay.
So this will be the neutral context. And in all the other cases, we will have a not confirmed context.
Okay. What are the other cases that you were talking about?
For example, if you have long 55% and short 45%, because the majority 55, it's not in the range 60 and 70, and it is not above 70.
Okay, that's cool. Thank you very much.
So we have only three status, either bearish or bullish, or neutral context, or not confirmed context.
That's
so
four. Okay.
Yeah, but the bullish or bearish define a specific context. So I consider this is one case.
Okay.
And in this case, we have two sub-cases, long or short.
Okay, thank you.
Okay.
Yep.
So clear context or neutral context or not confirmed context.
Okay.
Okay.
Yep. Thank you.
Yeah. No problem. Of course, if you find interesting to clarify some points, some detail, it's a good point to have that clarification. So.
Yeah, and I'm trying to write up notes at the same time as I'm listening, so
yeah,
it really messes things up. Okay, cheers.
Okay. And in the session number 2, you will have a big surprise, because you will see that when we will define all the possible conditions with the different indicators and script we will use, we will have a nice matrix. And so you will trade in the matrix. You know that I like some mathematical tools, and this matrix will give you a very clear vision what kind of trade, depending on the conditions you will see on your tools, you will see what kind of trade you can take. So now let's consider the first indicator we will call the no market profiler. Some of you already know what a market profile is. We may have a market profile with the price, and we may have the market profile with the volumes. And in fact, the market profile generally is a tool which has been invented, I think, in the 60s or 70s, so a long time ago in the stock market, to have another vision of the activity, the levels of activity in the market. And of course, because in the Forex market, most of the activity is generated by the institutions and the big banks. In fact, I have used the general term institutions here. In reality, when we use the term institutions, we mean the big hedge funds. And then we have the big banks. But it is also a usage among many traders to mix both of them and to define institutions as big banks and big hedge funds. So in this case, we will consider these two types of actors in the market. And so the market profile will provide another way to consider the level of activity by the institution trader, and they will help to define, in fact, special price levels. Special price levels where we may have a special activity by the big boys, in fact. And so we will have to pay attention to these levels when the price will approach these levels. In fact, for those of you who are subscribed to the max price levels, you will have similar level of activity in the pairs for which I defined these institutional levels. And so it will give us, in a very dynamic way, as you will see in a moment, a global vision of the volumes, but also of the price, because we will use both the price and the volumes. And of course, in this case, it will be the tick volume. But if you have a broker with a large customer basis, the tick volume will be accurate enough. And so it will be enough correlated to the real volumes. So we have to do with the information we have. And these levels, in fact, depending on the relationship between the price and these levels, will help to validate or to invalidate some setup. And so in some circumstances, the levels will be extremely important for some trade, and in some other situations, so it will invalidate the significance of a setup. So now, how is the market profile working on the chart? Let me show you first of all with a screenshot. So here, you have here the price, a naked chart with the price, and I have chosen a specific day. Now we will use the market profile in a specific way, but we can use the market profile indicator I will provide you in a very general way, and we will have to consider a period start, a period beginning, and an end of the period. So we will have to consider what is happening inside a time period. The first vertical line will represent the beginning of that time period, and the second vertical line will represent the end of this time period. And inside the time period, the blue chart will represent the price levels, and the pink chart will represent the volumes level. What does this mean, in fact? If you consider a specific price level, because we have a price level, so here, this means that along that period, how many times the price came to that level. And so we can count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and so on and so on. And so this horizontal blue bar will represent the number of times the price inside that time period has reached this price level. And so we will have a set of price levels. Each price will be a level, and the size of the horizontal bar will represent how many times the price has reached that price level. And we can see that there are two very specific or special price, the lowest low of the period and the highest high of the period. Very often the lowest low will represent one price, and the highest high will represent one price, because the price will touch this extreme level only one time. And if we are inside a concession zone area, there will be one specific price level which will represent the majority of the price has reached. And we will have similar information, but this time with the volume. And so this will represent a volume level. Each horizontal line will represent a volume level, and so it will represent the total number of volume, or tick volume in this case, the price has created inside that time period. Okay, and so it's another way to observe the price behavior and the volume behavior inside a time period. So now, when we will apply the market profile on a specific time period, we will be interested in several price levels. If we consider the volume, the price level, we will be interested by the lowest low, the highest high, and then there will be three levels which will be extremely important. There are two horizontal levels which will engulf 70% of the price. 70% of the price. So this means that this histogram, it's an histogram, or 70% of this histogram will be contained between these two horizontal levels. And they are calculated in such a way to have exactly 70% of them, 15% above, 15% below. And we will have also a specific price level which will correspond to the most frequent price level, which will be called the POC, or price of control. I will define the period in a moment, Chris. For the moment, I explain for a general period, okay? So we will have the lowest low of the period, the highest high of the period, the most frequent price of the period or price of control, POC, and then the two levels containing 70% of all the prices with 15% above, 15% below. And we will have something similar with the volume. So we will have the volume of control, the VOC, then which will be perhaps somewhere here. Then we'll have the two levels containing 70% of all the volumes, 15% above, 15% below, and we will have the two extreme, which will correspond also to the lowest low and the highest high of the day. And all these levels will be extended on the next period, because it is among the next period that these levels will play an important role. And so, knowing that we will scalp during the entire day, we will apply, in fact, the market profile on the entire previous day. If we trade today, or if we want to trade tomorrow, for example, we will apply the market profile to the entire present or today day. Okay? And so this is how the market profile will be used. And so once we will have defined these levels, sometimes we will see that the price will approach or come very close or will cross some of these levels, sometimes just one, sometimes several along a day, downward or upward. And a level will be extremely important when we will have that condition. You see here this green candle, okay, this green candle. So let me take my red spot. You see this green candle. This green candle crosses this level, which is one of the level we have drawn with the market profile applied to the previous day. When such a candle crosses such a level, one of the conditions for an entry setup will be, in fact, fulfilled. This will represent one of the conditions. But it may happen, if you observe the next candle, the last candle on the chart, the last candle does not touch the level. And so the level may be a price level or a volume level. Don't forget that. It does not touch because the low of the candle is a little bit higher than the level itself. And what will be important is that distance between the candle, in this case, the low of the candle and the level. If the distance is less than 2 or 3 pips, so if it is no more than 2 or 3 pips, then the level will still be extremely important. If the distance is more than 3 pips, the level will not be important. We will not take into account the level. So the level will have to be into account when, first possibility, the candle crosses the level. Second possibility, the candle does not touch the level, but it's close enough to the level. Okay? And this will be true for the price levels and for the volume levels. We have different lines, yeah, but we will not make the difference between the price level and the volume level. No, we will have 1, 2, 3, 4, 5 lines maximum for the price and 5 for the volume. Because remember, if I come back to the previous slide, if we take the price market profile, we have the highest high, the lowest low, we have the 70% level, and we will have the POC. So we have 1, 2, 3, 4, 5 levels maximum. Sometimes several levels can coincide, but we will have maximum 5 levels for the price and 5 levels for the volumes. Yeah, they may be close together. Indeed, they may be close together. And when they are very close together, by 1 or 2 pips, we can consider that we have only one line. And so this is how such a level will be important. So now let's see how to add the market profile on a chart. So now I'm going to come back on the chart. We are today Monday, and so in order to apply the market profile, we have to consider the previous day, which in our case will be Friday, and I will make a small zoom out just to see the entire day, okay, that way. And so we have the indicator which is called no market profile. No market profile here, no market profiler, sorry. I'm used to use the original name market profile. So we drag and drop the indicator on the chart, okay? And then what you will have to do is click on, and I hope I will make no error here, we click on OK. And then when you have clicked on OK, you have to push at the same time, I think it's the control key. Am I right, Gregory? Is it the control key or the shift key I must use? Or perhaps not. Let's try. I will use no control key. We click on the first candle of the day, and then we click on the last candle of the day. And whenever you will have, so yeah, just click. So a red vertical line displaying, and when you click on the last candle of the day, so you have the market profile displayed on the chart. And if, so I somewhat, or let me take out the script, okay, just to show better how to do that. So I have drawn the market profile on the entire day, the previous day, and now I will just draw my horizontal line. So we will use, for example, red horizontal lines on the top and green horizontal line at the bottom. So I will use, first of all, the price volume. So here I will draw my horizontal line on the highest high. Observe that it corresponds also to the highest volume. Then we will take here, you have an horizontal line for the 70%, so here. Then we have the second line for the 70%, so here, and we can draw it in green, for example. Then we have the lowest low, so here, which corresponds also to the lowest low in the volume profile. And you have here, in pink line, the POC, which represent, in fact, the majority of price. And then we will draw another line on the POC. And you can see that in this example, the POC coincides also with the VOC, the volume of control. And on the volume profile side, you can see that we have the 70% line, so here just a little above, which is different from the 70% level on the price. And we have here the volume, the 30% level, which is almost identical to the price level. And so we have in total, in this case, so 1, 2, 3, 4, 5, 6, 7 lines, not 10. And of course, I have forgotten the volume of control, which is identical to the price of control in this case. This is why we have 7 lines only, because 3 are identicals in the volume profile with the price profile. Okay, so the market profile will give you all the levels you need, and so you have just to draw these horizontal lines in order to have them on the next day. And on the next day, when the price reaches one of these levels or come close enough, maximum 3 pips, so these levels will become important for some types of our entry setup. Okay, is it clear how to draw the market profile on the chart? Let me repeat it again. Let me open another pair. I will take, for example, this was the euro US dollar. Let me take the pound US dollar, and I will use a naked chart. Let me draw the day separator, properties, period separator. Okay, and let me make a zoom in. So to have the previous day, we drag and drop the indicator on the chart. We click on OK. Then we click on the first candle of the day and we click on the last candle of the day. And then you will have all your levels. The pink level here represent on the price side the price of control, the most frequent price, and on the right side the volume of control. And so you have already a first volume shown here, a first line, and in this case they coincide. Okay, then you will have the 30% level, so here on the price side, and very close on the volume side. That way, then we have the lowest low. Of course, they are identical, and then we have the highest high. That way, we can draw them in red, for example. And then you have the 70% level on the volume side. And in this case, we have a different 70% level on the price side. So in this case, we have 1, 2, 3, 4, 5, 6, 7 lines again. Why 7? Because we have for the price and the volume the same highest high and highest low, and we have the same, the POC is equal to the POV in this case. Okay? No, it is not, Ralph. For the day, we have to consider the entire official day. So you know that a day always starts with at 5 p.m. New York time and ends on the next 5 p.m. New York time. So it's always from 5 p.m. New York time to 5 p.m. New York time. Of course, if my trader, my broker, in this case, my broker, which is TradeView, has its midnight corresponding to 5 p.m. New York time, this means that this broker has its time zone 7 hours ahead of New York time. This is why 5 p.m. New York time corresponds to midnight with this broker. And so you will have to pay attention. On your chart, depending on the time zone of your broker, you will have to pinpoint the official beginning of the day and end of the day, which corresponds always to 5 p.m. New York time. Okay? And it's the entire day, 24 hours. Okay? Yeah, no problem. You're welcome. And then once you have drawn your horizontal line, so your price levels, so you have your levels ready for the next day. And you can see whenever the prices crosses a level, this will be an important condition for some of our setups. If the candle does not touch a level, for example, like on this candle here, the price, if I make a further zoom in, we can see that the price does not touch the level, but it is close enough, less than 3 pips. And so it will be significant too. Now, if the candle is too far away, you can see here that the candle is at more than 13 pips. So this candle or this level will not be significant enough for this candle, should this candle be an entry setup. Okay? Yeah, the 70 and the 30% level will be called the VAH, VAL, so volume high, volume low, and for the price high, price low, in fact. So this is for the market profile. Is it okay for the market profile? And so on the right side of the indicator for the market profile, you will have the information about the volumes or the tick volumes in this case, because the information are taken from your data feed. And on the left side in blue, we have the information about the price. Okay? Good for the market profile? Okay. Let me cut my microphone just a few seconds. I need to take a sip of water because my throat is drying. And if I don't soften my throat, I will become unable to speak, which would be a disaster. So let me take a sip of water. Okay, Now it's better. Okay, now that we have seen the market profile, which is an important tool because this level will play also a very, very important role later. So let's come now to the next tool. And the next tool is also an essential tool, which is called the Cumulative delta. And what is the cumulative delta? In fact, the cumulative delta indicator will give a more precise idea of the price of the volume and the price in a context of trend. And it will really indicate, in fact, in which direction the market is trading. Because if you consider a chart with the standard volume, at worst you will have a vertical bar for the volume, and all the bars will be in the same color. This is what by default MetaTrader display. If I display on the chart, for example, the volume of that day, you can see that the volume are given here in green, but you don't know for each volume if it is a volume to the upside or a volume to the downside. A volume to the upside will correspond to a volume when the price goes up, a volume to the downside when the price goes down. And moreover, you will not know when there is a sequence of price going upward if the volume is going up and up and up, and similarly in a downtrend. So the raw representation of the volume does not give an idea, an accurate idea of the volume activity in the market. So there are some versions of the volume indicator which gives you a green bar when the price is going upward or a red bar when the price is going downward, but you don't have a global perspective because you must analyze each volume individually. But we can analyze the volume behavior in a global way, in a more global way, with this cumulative delta indicator. And it will also provide precise turning points associated with, so these volumes will always provide precise turning points in the price action. And this is extremely important to consider when we have a more better vision of the volume activity. And it will be so extremely important to define the entry but also the exit of a trade. And so it will validate or invalidate the significance of a specific setup. And so this cumulative delta will be one of the most important indicator in the scalping system. And it works in the following way. So you have here on this slide, so the price, and below you have the cumulative delta. And so instead of drawing each volume individually, we add the volume. And as long as the price moves downward, we add the volume to the downside. And when the price moves upward, we add the volume to the upside. In such a way, we have the real dynamics of the volume. And in this case, we can see that the market, the cumulative delta, is going downward. Usually, but it will not always be the case, the cumulative delta will move in the same direction as the price. The price is in a downtrend, it's going downward, and the cumulative delta will also go downward. And so here, in this case, we will have a bearish context, and we will associate a trend line with the cumulative delta, a trend line showing the bearish bias, the bearish direction. It's bearish because it has a downward slope. Okay, the trend line is going downward. In some other circumstances, when we will have to adjust the trend line, and I will explain how we will draw the trend line. In fact, we will consider always, just to make it clear immediately, we will always consider at some point the high, when we are in a downtrend, okay, we will, or in a bearish context, we will always consider the highest point in the cumulative delta, and then we will draw the trend line through the next high, and then we will extend the trend line. And if there is another high which crosses the trend line, we will adjust our trend line to the new high. I will show that in a chart if I have the opportunity. So similarly, when we will be in an uptrend, so we will be able to see that the cumulative delta is going upward, and we will have to draw an upward trend line. And eventually, we will have to adjust it several times along the day. And this trend line will be called long-term trend line, or long-term context in the cumulative delta. So now let me show you how it works on the chart. And here you will have to pay attention to the chart, because there is something special with this indicator. The indicator is called the no cumulative delta. And so in order for the indicator to display, okay, you have to let your MetaTrader platform running. If you add simply the cumulative delta indicator to a naked chart, you see, not this one, let me open a naked chart. For example, the pound to a dollar here. If I add the cumulative delta indicator, so we have simply drag and drop, and there is no parameter. There is just the colors of the volume. Red or crimson if it is downward, green if it is upward. We click on OK, and you will see nothing, because the indicator will begin to appear whenever a price quote will appear, so whenever a trade will happen. And so this is an indicator which will be built in real time. And in order for the MetaTrader platform to accumulate the cumulative delta, you will need to keep your charts and your MetaTrader platform open. If you stop your MetaTrader for 1 hour, you will have a hole of 1 hour in the indicator. This is why I have run my platform almost at the beginning of the market today. And this is why on each chart I have the cumulative delta of the day. But if you observe Friday, I have nothing, because my platform, this platform, was not running that day. So you need to have your platform running in real time in order to build in real time that line, bar after bar. Okay? This is extremely important. Otherwise, you will not accumulate the data. And unfortunately, there is no other way to build this cumulative delta. This is a problem in all the charting platform. In fact, whatever the charting platform you may use. Now, so how do we draw the trend lines? We see that here at some point, in fact, I have started my platform 2 hours approximately after the beginning of the day, because I had forgotten to launch the platform right at the market open. But at some point, you will see if the context is an upward or downward context. So we can make a refresh if we want sometimes, so refresh. So now, how do we draw the trend lines? At some point, you will pinpoint, you will see if the price, if the market delta is going upward or downward. It will be clear, it will be obvious. And here, once we have pinpointed this low, after that low, it's clear that the context is bullish. And globally, the price is also bullish. How do we draw the trend line? So we start with the first low, and when we pinpoint a low, the next low, so we draw the trend line that way. Okay? And for the trend line, so we will draw the trend line in green. Trend line in green. Green. That way. Okay? And then we leave the cumulative delta continue to build. And when we will pinpoint another low, we will adjust eventually that way, see? And then we have the next low. We will adjust that way. Of course, we will extend the low. And then when we will reach the next low, you see here the price on this next low crosses the trend line. But it's not a problem to adjust the trend line on the next low, provided the trend line stays upward. And so the trend line can move higher or lower, but provided it stays upward, this is what will be extremely important. And so you will build your trend line always starting from the lowest low in the day, and then you will build it, see here, at the end of the day, you can adjust your trend line that way. And what will be important, in fact, with that kind of trend line is when we are in a trade, or when it will help to define an entry setup, and it will help to define an exit setup. So it will be necessary to see what is happening in this cumulative delta with the trend line in order to open the trade, and in some circumstances, it will force us to close the trade even if our target profit is not reached. Because this line, the cumulative delta, indeed, will be extremely important for the life of the trade. There will be a nuance I will introduce next week. Sometimes we will have to draw a short-term trend line. For example, once we draw, let me illustrate that with an example. Let's suppose we are at this low here. Okay? And we are not